In this video, we continue our discussion on Chapter 10, in which we go over market outcomes, where in our last video we went through the profit maximization process for a monopoly. In this video, we seek to go through market outcomes for monopoly, in which we do so by considering some preliminaries in order to discuss monopoly profits and conclude with market outcomes. Where in regards to our preliminaries, we saw that in the profit maximization process for monopoly that profits are maximized when marginal revenue is equal to marginal cost, where at this point, when the monopolist decides to produce an additional amount of a good or service, the amount of additional money flowing into the company is equal to that of the additional money flowing out of the company, such that if they were to decide to produce an additional unit of the good or service in question, they would begin to lose money, whereas if they decided to scale back production by 1 unit, they would see that they would have room to generate more money. Therefore, at this point, there's no incentive for the monopolist to produce an additional unit of the good or reduce production of the good or service in question by 1 unit either. Therefore, at this point when marginal revenue is equal to marginal cost, this pins down the optimal quantity for the monopolist to produce and sell. And since the monopolist has market power and is the sole firm operating in the space, they consider the market demand curve in terms of their pricing strategy such that they do not use marginal cost pricing. And we have our graphical representation of this below, where we have our production function that we saw in video 2, as well as our profit maximization process, where profits are maximized when marginal revenue is equal to marginal cost, giving us an output level of 3 corresponding to point D. And in terms of our pricing strategy, we use the market demand curve for when output is 3 in order to determine our price level of 3 as well. We're moving along to our production function, producing at point D, in which there's 3 kilowatt hours of electricity produced. This corresponds to the monopolist using 45% of their labor force. Such that now with this information considered, we now seek to examine monopoly profits as well as market outcomes in a monopoly compared to that of a competitive market, where first we begin with monopoly profits, where we will need 2 things. The first is our formula for profits, where recall that we can calculate this as the difference between price and average total costs, all scaled by output quantity, where price minus average total cost will give us profits per unit. Scaling that by output gives us total profits. And the second thing that we'll need is our average total cost curve in terms of our profit maximization process. So with that in mind, let us now consider our profit maximization process and incorporate average total costs. So let us move to our table representation and generate our average total cost curve. So beginning with our point D, let us first recall that average total cost is going to be total cost divided by output. With that in mind, turning to total costs, we see that when output is 1, total cost is 75 cents. Dividing that by our output level of 1 gives us an average total cost value of 75 cents for point B, which is going to generate our point B on our purple average total cost curve. Moving to when output is 2, we see that average total cost is $1.50. Our output level is 2. Dividing $1.50 by our output of 2 gives us an average total cost value of 75 cents for point C, which generates point C on our profit maximization process for our purple average total cost curve. Now moving on to our next point, when 3 kilowatt hours of electricity is produced, total cost is $2.50. $2.50 divided by 3 gives us an average total cost value of 83 cents, such that we generate point D on our profit maximization process with this information. Now moving on to point E, this is when 4 kilowatt hours of electricity is produced. Total cost is going to be $3.75. Dividing $3.75 by 4 gives us a value of 93 cents in terms of average total cost, which generates point E for our average total cost curve. And lastly, we now consider point F, in which 5 kilowatt hours of electricity is being produced, and total cost is $5.25. Dividing $5.25 by $5 gives us an average total cost of $1.05. Therefore, we generate our point F on our average total cost curve, where we now have our U-shaped purple average total cost curve through this process, where it's downward sloping when average fixed cost is dominant and upward sloping when average variable costs is dominant. So with this curve in mind, let us now turn to our graphical means of calculating monopoly profits. So in terms of price minus average total cost, let us move to our profit maximizing bundle when marginal revenue is equal to marginal cost, which corresponds to point D at an output level of 3. And then now let us turn to our pricing strategy, which is going to be our first component that we consider. Our pricing strategy corresponds to the market demand curve at a price point of 3 when output is 3. And then now we need to consider our average total cost at this output level, which is going to correspond to our purple curve. We're at point where when output is 3, average total cost is 83 cents. In terms of graphically looking at this, this is comparing is our pricing strategy above or below or equal to our average total cost curve. In this case, our blue pricing strategy in terms of market demand is strictly above our purple average total cost curve. Therefore, we would expect the difference between the two to be positive. That is positive profits per unit. And when we were to scale that by total output, we would have positive total profits. Verifying this with our table representation, we see that at point D, with a price point of 3 and an average total cost of 83 cents, the difference between the two is going to give us a positive profits per unit, as we saw with our graphical interpretation. Scaling this by our quantity level of 3, we would get positive total profits as a result, as expected, as we saw in our graphical representation. So then overall what we saw in our last slide was when marginal revenue is equal to marginal cost, this gave us an output level of 3. And when market demand was at a value of 3 in terms of output demanded, this led to households being willing and able to purchase the goods at a price point of 3. In terms of average total cost, when the output level was 3, our average total cost was 83 cents, such that in terms of calculating our profits per unit was $3 minus 83 cents. Scaling that by our total quantity of $3 gives us a total value of $6.51 in terms of total profits, where this is in line with our manual profit calculations of $6.50 that we saw in video 2, where we do have a discrepancy of 1 cent due to us working with averages as opposed to the concrete numbers that we did in video 2. Therefore, we see that positive economic profits exist for a monopolist through this work. So then, with our profit calculations considered, let us now compare market outcomes for monopoly with that of a competitive market, where we will consider the monopolist as well as treat the monopolist as a competitive market. Where on the left-hand side, we have our monopoly, and on the right-hand side, we have our competitive market. Beginning with our monopoly, we have our process that we saw on the prior slide, marginal revenue is equal to marginal cost, corresponding to point D, output level of 3, moving up to our pricing strategy and market demand, this corresponds to a price point of 3. Now, moving over to our competitive market, we now have our downward sloping market demand curve and our upward sloping market supply curve, where market demand is identical to that of our market demand curve in the monopoly problem, and our market supply curve is identical to that of the marginal cost curve in the monopoly problem. Since this is a competitive market, when market supply is equal to market demand, this is going to pin down our market equilibrium, which is going to give us a value of 4.5 in terms of kilowatt hours of electricity at a price point of $1.50. Where this is going to correspond to a short-run equilibrium for the competitive market, where for the short-run equilibrium, there will be positive economic profits, and we see that it's strictly greater in terms of output than that of the monopolist, and the price point is reduced as well. In addition, if we were to consider the long-run equilibrium, that is the minimum average total cost equaling that of marginal cost equaling marginal revenue and the price of the good, we turn to our monopoly representation, we look at our minimum value of average total cost, and we move up 75 cents, and we move to the right until we reach our market demand. We would see that the long-run equilibrium for this competitive market would have a price point of 75 cents and an output level of 5.5 kilowatt hours of electricity, in which we see a greater amount of output in the market at an even further reduced price point compared to that of the short-run equilibrium, and especially compared to that of the monopolist outcome as well. Now, the last thing that we would want to consider as well, though, too, is consumer surplus. Or recall, this is the difference between what consumers are willing and able to pay and what they actually pay. Or we would calculate this as the difference between the point on the market demand curve and that of the price point, where for the monopolist case, this is going to be a price point of $3. So this would be the difference between each point on B, C, and D, and taking the difference between that of the price point. And if we were to do that for the competitive market outcome, where the price point in the short run equilibrium was $1.50, and doing that for points B through somewhere between E and F, we would see that consumer surplus in the competitive market is greater than that of the monopolist outcome. And if we were to do this for the long run equilibrium of the competitive market, in which output was at about 5.5 with a price point of 75 cents, calculating consumer surplus, we would see that consumer surplus is larger than that of the short run outcome and that of the monopolist as well. So then, examining market outcomes, we saw that from the monopoly standpoint, that in equilibrium, the output level was 3, in which there was a price point of 3 as well, where the monopolist generates positive economic profits, and that consumer surplus was relatively small. Whereas compared to the competitive market, in its short-run equilibrium, the output level was around 4.5 with a price point of around $1.50, in which positive economic profits existed. Whereas in the long-run equilibrium, the output level was around 5.5 and the price point was 75 cents, in which there was zero economic profits. Where in both the short and long-run equilibrium, consumer surplus was larger than that of the monopolist outcome. Where overall then what we saw was that the competitive market leads to a case in which there's more output and a lower price point in equilibrium compared to that of the monopoly, as well as the competitive market leads to a larger consumer surplus than what the monopolist allows for.